Good morning, everybody. Welcome to Coffee with KPP Live, the show dedicated to providing advice for life so that you can live richly and work towards the life that you've earned. My name's Kyle Roy. I'm a financial advisor with Kentucky Planning Partners based in Louisville, Kentucky. And I'm pleased to have joining me today, Jeannie Samdani, another financial advisor and valued member of our team. Welcome, Jeannie.
Thank you.
Thank you. So Jeannie has been in the financial industry for some time, and we've been friends for 6 or 7 years. In my previous life, I called on Jeannie, and we built a relationship, me on the corporate side, Jeannie as an advisor, as with so many other advisors in the area, in the region. So this is a real treat to be able to talk to Jeannie and introduce my friend to the community that we have on Facebook.
Oh, thank you very much. Kyle really stood out among the many people that came to our office because of his integrity, and he's also incredibly articulate. So, he's definitely been doing a great job informing people about what's going on.
Well, thank you. I appreciate that.
Absolutely.
And to be able to do this on the same team, on the same side of the desk, is really exciting.
Yes, it is.
And so Jeannie is the conversations that we always have, I think, are always really insightful. I always take a lot from our conversations and have over the years, and I'm excited to be able to have a conversation with you and share with our audience some of the knowledge that you have. In particular, we're going to be talking about the markets today. Yeah. And what we're going to be doing is looking at the current state of the American economy, the American equity markets in the first quarter of 2021 today. In the last 12 months, we've had extraordinary amounts of volatility, uncertainty, political unrest. We've had election cycles. We've had a lot of change, and we've also seen tremendous market movements as well. And Jeannie had the great idea to talk about, well, what are both sides of the coin? Because it seems like a lot of people are worried that we're going to be seeing another dip in the market, perhaps. And there are just as many people that feel like we're just going to continue to see this rally. So what we're going to do is talk about both sides of the coin. So the person for whom this conversation, I think, will be helpful is anybody that has a general interest in the markets, that if any investors, if you're investing in your 401k, or if you're an individual investor that likes to pick equities on their own, we're going to give a relatively high-level overview of the markets, where we sit now, and what analysts on some of our partners are saying about where they think the markets are going based on current data. So we're not going to be giving any promissory statements. We can't predict the future. If any financial advisor tells you they know what the future holds, run away, don't walk away. Right?
Absolutely. Absolutely.
All right.
Nobody's got a crystal ball, and the older you get, the more you realize that things always there's always going to be unexpected things in our future. That's just life as we know it.
That's right. So before we do you want to jump into who you are, give a little background about yourself, Jeannie, and tell the audience a little bit about you?
Well, not at great length, but I do specialize in retirement income planning, and the people I enjoy helping most are people of middle income, middle resources that are in their 50s, 60s, or 70s. That's a really critical time to have a financial planner by your side. And with the markets always being uncertain, it's just a great time to have somebody help you to figure out how you're going to navigate this.
Fantastic. All right, so let's dive in. So this topic was your idea, and I love it. I'm really excited to talk about it. So why don't we start off by telling what were some of your thoughts, and why were you motivated to have this discussion on this media?
Well, I think it's a very interesting subject, obviously, but we do have very strong arguments for the market is going to continue to grow. And yet at the same time, we have some very strong reasons to suspect that this isn't going to go on forever, obviously. But how long will it go on? Nobody knows. But there are things happening that are sort of setting the stage for a possible either the market coming down rapidly or maybe very gently. But certainly coming down from where it is at the moment. There's certainly things that are happening that are setting the stage for that.
Okay, so let's talk about that first. Okay. So let's look at the bear market side. So the bear market side of the equation is that the markets are high, and some people believe that we're maybe a bit frothy at the point, and that we might see a downward trend in the market. So let's talk about that. Why do you or some others might believe that could be the case in the shorter near term?
Okay, well, I've been recently thinking of it in terms of a bit of a double bubble. I kind of just like it because it rhymes, but also there's a sort of something going on in the market here where generally, when I say the market, let's talk about the S&P 500 first, and just let you guys know what we mean by that is 500 of the largest publicly traded companies in the United States. So that's what we mean when we say the S&P 500. So we'll stick with that. So what you've got is you've got a situation where the prices are very high by historical standards, and almost every analyst will agree with this. And then you also have a situation where some companies have done quite a bit better than others, especially on the tech growth side. And so that is a bit of that sort of, we've got possibly two kind of bubbles. We've got a little bit of a general bubble, and then we've got this specific kind of tech growth bubble that really looks frothy by many people's standards. So in a moment, I'm going to talk about the PE ratio, and I know most people don't want to get technical, but I think that's an important number, and I'd like to define that. But let's get back to you, Kyle.
Yeah, no, let's define that. I think that's important. So when people say that prices are high, when we look at the stock market, each stock value is the price of an individual stock, right? So we know that Tesla, for instance, as a company in the S&P 500, is priced higher than other companies in the S&P 500 as well. But just because the price of that stock is higher doesn't necessarily mean that it's a expensive stock.
Yeah.
So that's where Jeannie is going to do a great explanation of what's called price to earnings ratio. It's a technical term that we in the financial services industry use, and I think Jeannie's got a great analogy on how best to understand it. So let's help our viewers understand what PE ratio means.
Okay, we're going to give this a try.
You'll do great.
I'm going to use a hypothetical example. I wish this was me, but it isn't. But let's say that you had been tinkering on the side and you'd gotten yourself a little internet business going, and you made $100,000 off that internet business last year, selling warm mittens, warm hats, thermal socks, things that have been very popular lately. And all of a sudden, somebody like Warren Buffett takes an interest, and they come to you and they say, hey, this is a great little business. Would you like $1 million for this business that earned $100,000 for you last year? That would be a price to earnings ratio of 10, because he's offering you 10 times what it earned last year.
So to stop for a moment, so if you made $100,000,
and somebody offered you $1 million,
somebody offered you $1 million to buy that company,
to buy the business.
So your income was $100,000. Keep it simple.
Your
earnings, and somebody offered you $1 million. That's a 10-to-1 or 10 PE multiple.
PE ratio or PE multiple, yes. A very common term in the financial industry, but I don't hear it being talked about much in the public domain. But it's important here. Okay, so let's say that he offers you $2 million. That's a PE of 20. So
you're earning 100, or your earnings are 100,000, and somebody offers $2 million to buy the company. That's a 20.
PE of 20.
PE of 20. Price to earnings ratio of 20.
Now I'm starting to think about it, right? But what if he comes along and offers me $10 million? Okay, now we're at a PE of 100. Am I correct? 100,
that's right.
Now it's getting super attractive, and I'm like, you know what? $100 million from my business that earned $100,000 last year? Okay. Obviously, he thinks this company is going somewhere, right?
So a good way to think about it too is, so in other words, if Warren Buffett offered you that $10 million for the company with $100,000 of earnings, it has a PE ratio of 100, and you could hypothetically say, well, it would take you 100 years to earn the $10 million that is being asked to purchase from you.
So I'm buying an island instead. Yeah, definitely. But here's the thing: the PE of Tesla right now, last time I checked, was about 192. So what that means is that this company is being priced with eyes for the future. Where is this company going? Where do we think it's going? And when you get away from historical results and you start to base the price of a company completely on what you think it's going to do in the future, you're getting away from what would be sometimes called investment and into speculation. And certainly it looks rather hopeful and optimistic, possibly overly optimistic.
So let's back away from Tesla for a minute.
Sure.
So what's the PE ratio on the S&P 500 now, the general market?
Okay, well, it depends on how you define it, but I like to look backwards, and I like to use a number called the Shiller price-earnings ratio. So you can look it up if you Google it. Even if you don't spell it correctly, you'll go to the correct place.
So it's the Shiller
PE.
PE, Shiller
So
PE.
the Shiller PE, what it does is it says, hey, let's look at today's prices, and then let's look at what these companies earned over the last 10 years. Adjust for inflation. Okay? Right now, the Shiller PE is a little bit over 35. It's never been this high before except once. In 1999, right at the top of the dot-com bubble, it was just a little bit under 45. That's the only time in history it's gotten that high before. That was not a good time after it burst.
That's right. 99 was great. Yeah, 2001 to 3 by now.
So what people are saying, what analysts are saying is, look, we're not really expecting the sky to fall tomorrow. Nobody's really, a few people might be predicting that, but very few people are predicting that. But what we might be looking at is a rather long period of very mediocre returns in the stock market. Possibly, a lot of people basically, if you're looking at averages, are looking at about 6% or so on an average basis for the next 10 years.
Okay.
That's pretty mediocre, especially if you consider that doesn't account for inflation. Inflation could be 2 or 3%. If you're getting 6 and you take out your inflation, you're not really getting much of a real return. If that were to happen, it would be kind of hard on a lot of people, especially those people who are using their portfolio for a foundation of where they want to be in retirement over the next 5 to 10 years.
So
that could be rough.
Yeah, so with the Shiller PE.
PE.
Sorry about that.
Okay.
My dyslexia kicked in there for a moment, didn't it? So the Shiller PE is one metric, and I think it's an important one. To your point, it's at the highest level that it's ever been, second highest level ever. The only time it's been higher is right before the dot-com burst of 1999-2000.
Exactly.
Yeah. Now,
so that's a bit worrisome.
But it's important to note, though, there are two ways that the markets can come back to equilibrium as it relates to price to earnings. Mm-hmm. The first way is, like you described, stock prices can come down.
Or at least stop going up.
Or stop going up, so that what happens? So the value of the companies actually catch up. Mm-hmm. So right now, if we have a high price to earnings ratio of a company and investors are buying that company, it's under the expectation that the company is going to ultimately perform to that level of profitability or cash flow. Mm-hmm. So if companies actually realize that, then we could see an economic boom, right? So the contrarian party to the bears would say, I think that it is speculation, yes, to buy a equity with a high PE, but are there other metrics or statistical data that points to the potential that we could see the prices of those companies rise?
Mm-hmm. Yeah.
Okay.
Yeah.
So let's talk about that for a moment, perhaps.
Okay.
Right?
Okay.
Because you're right. There are, and again, the beauty of this conversation is none of us have a crystal ball.
Right.
But these are fun conversations because as financial planners and money managers and financial advisors, we always need to think about these things, because Wayne Gretzky famously said he wasn't the greatest because he skated to where the puck was. He skated to where the puck was going. Mm-hmm. And that's granted, we don't know necessarily where the markets are going, but we always want to try to be as well educated as we possibly can. Okay. So there are a couple things now that point to positive metrics that the markets may do well. So last year, there was a tremendous amount of fear in the market. Mm-hmm. And when people are fearful, what do they generally do with their money?
Well, they pull out and they put them into money market funds.
That's
among
right.
Other things.
So let's talk about that. So let's look at money market funds today. So money market funds are a fancy word for cash. They're cash-like investments, highly liquid, earning very little, if any, when you invest. Yeah. So with the fear in the market last year because of COVID, because of political, social unrest, what happened with money market funds last year?
Well, speaking about what I learned from Bright House actually was that a little over 1 trillion pulled out of the market and went into money market funds right around the beginning of last year, at the height of when people were concerned, and that hasn't come back in yet.
Mm-hmm.
And we've got a total of 4.3 in money market funds.
So
sitting on the sidelines of the market, and that, is certainly money that could come back in. I guess my thought process is that yes, we do see a pretty decent, reasonable expectation and likelihood that the market is continuing to grow, but how long would that go on? That is the really difficult question to answer. We certainly do have the foundation for continued increases in prices.
That's right. And to your point, so what Jeannie said, I think, is really important. Mm-hmm. Right now, there's approximately $4.3 trillion
yes.
of investors' assets in money market funds. It is the highest level that we've ever seen ever. Mm-hmm. And there's a great resource that I heard. It's a podcast I've heard years ago, and I'll reference it in the notes if I want to make sure I give credit where credit's due. But it's the concept of the time millionaire. And let's put $1 trillion in perspective. This is an extraordinary exercise, I believe. Okay. 1 million seconds. 1 million seconds represents just over 11 days. Okay? 1 billion seconds is about 31 years. So the difference between 1 million and 1 billion, 1 million seconds is 11 days, 1 billion seconds is 31 years. That means 1 trillion seconds is 31,000 years. 31,000 years represents 1 trillion seconds. Okay. We have $4.3 trillion sitting in money market funds right now. Okay? So people are scared. Warren Buffett has famously said, when people are scared, be greedy, and when they're greedy, be scared. And right now we see investors justifiably in money markets. And historically, where have those funds gone? Those assets gone?
Well, back into the market. But I think this is a tremendous opportunity for Kyle to talk about market timing, because it's very, very important. If you're going to have part of your portfolio in investments, I always tell my people that the stock market is a roller coaster. You have to know that it will go up and it will go down, and you have to be prepared for that and buckle up. Mm-hmm. Do it. Absolutely. Have a significant part of your retirement assets should be in the stock market in almost every case, but be prepared for that. Be prepared for the ups and downs. And when we had that dip in March, we didn't hear the phone call. We didn't hear the phone ringing here at Kentucky Planning Partners, because I think the advisors here have done an excellent job of being realistic and letting people know and understand that this is something you have to be prepared for, the ups and downs. You have to hang on. Mm-hmm. So if you could be so kind as to explain your time in the market versus timing the market, I think that'd be really helpful.
Sure, and thank you for that. That's beautiful, because you're absolutely right. And there will be, especially in the near term, there are going to be bumps in the road, right? If the market's down, last year the market was up or down more than 2%, greater than 50 times. So there were 50 days where the S&P 500 was positive or negative more than 2%. That's a bumpy ride, isn't it?
It is.
And that's scary, especially with your life savings. Yes. So it's not surprising to see people be fearful and get out. But to Jeannie's point, what she said is brilliant in that it's not timing the market that generally will help you with long-term performance. It's your time invested in the market, not timing the market, time in the market that helps. And we've got a great piece here from our friends at BlackRock. BlackRock is a fantastic mutual fund and money management firm that we partner with, do a lot of business with. And they've got a piece that shows if from 2000 to the end of 2019, if in January of 2000 you invested $100,000, and over that 19 or 20 year period, so if you over 20 years, you missed the best 25 days of the market, your investment would be worth $82,256. It's absolutely incredible. Whereas if you stayed invested the entire time, your investment would have grown to $324,019. So if you look at the time of staying in the market and understanding the risk that your portfolio is taking, the advisors at Kentucky Planning Partners, like Jeannie, like our team, what we all do is we make sure that our clients understand risk. Because everybody wants what?
They definitely want the rewards, and they're hoping there's something out there that will get them the rewards without the risk. And if I knew of something like that, I'd absolutely be offering it to everybody I know.
Right?
I love that.
Have your cake and eat it too.
I love that, absolutely. If you know about something like that, let me know, Kyle.
I will. And it's important because we don't know. We know at some point in our lifetime, if we live long enough, we are going to see another market correction.
Yeah,
it's an inevitability. The market corrects more than 20% on average once every 4 years.
Okay.
Once every 4 years. So when we look at the long-term growth of our clients, or the long-term objectives rather of our clients, it's important that we understand, in order to realize a long-term return, the cost of that growth potential is the volatility that you're going to see in your portfolio.
Or what we sometimes call risk. But basically what we mean when we say volatility, we mean up and down. That's what we mean. The fact that it's going to go up, it's going to go down, and you're going to get heartburn if you're not prepared for it.
That's right.
You don't want to be pulling out the antacid at 3 o'clock in the morning. That's not it. But it's really important to stay with it and not think that, oh, this is the time I should jump in, or this is the time I should jump out. That's what you've got to avoid, because we don't have a crystal ball. We could be sitting here today talking about how we think things are going to go well for the next whatever, six months or a year, and tomorrow it could go down.
That's right.
And we could be proved, we'd be looking foolish. It can happen to anybody, no matter how educated they are. They can be wrong about what they see around the corner.
And it's
so you've got to stick with it.
That's right. And it's amazing how our own bias can blind us, or maybe hubris can blind us from our inability to make the right decisions. So I grew up in Massachusetts around the time in the 90s where the Big Dig was happening. And the Big Dig was made famous because of the horrendous traffic that always surrounded Boston.
Okay.
And when we think about getting in at the right time and getting out at the right time, the analogy I always refer to is driving in traffic.
Okay.
When you're driving in traffic...
Oh, yeah. Everybody's always trying to dart from one lane to another, and the next thing you know, you're passing them, right?
That's right.
Yeah, they were like, oh, I got to get over here, and then you go, bye.
But we know if we just stay in the same lane when we're in traffic...
you'll get there.
We're going to get there.
You're going to get there.
But when we see that lane to our left moving past us, after maybe 30 seconds seems like an hour, what do?
We want to jump on over.
We jump over, that lane stops, and we see the truck that we were behind 20 minutes ago far, far, far away.
Yeah.
And it's no different in investing. And it's so important to make sure you're working with professionals that are understanding the macroeconomic aspects of the economy and the markets and what's going on. Also the microeconomic, what's going on at individual companies. How might an event in Indonesia or in China affect a significant holding that you might have? These are things that financial advisors do. But the most important part of all that is to help you understand how these investment decisions are working for you and working towards your goals, and how they fit into an overall financial plan so that you can realize that life that you envision for yourself and your loved ones. And that's what Jeannie and our advisors here at Kentucky Planning Partners do so well.
Okay. Do I have a couple more minutes?
Please, yeah.
Okay. So I just want to say that, again, I focus on retirement income planning. I really enjoy working with people in their 50s, 60s, and 70s. And before retirement, if you sit down 10 or 15 years before retirement, there's decisions you can make that will make a big difference. So really, it's much better to look at things seriously with a financial advisor 10 or 20 years ahead of retirement, rather than wait until the day that you get that severance package. Because you can just make things go better for you. But I really want to be sure that, to the extent possible, I insulate my clients' retirement so that they're not going to have to worry about whether the market goes up or down in the next 5 to 10 years. They should have money in the market, absolutely, for that long-term growth, but I don't want them to be vulnerable and their retirement income to be vulnerable to what happens in the next few years in the stock market. I think that's critically important, to look at the retirement income stream and make sure that's protected and secure. So that's kind of what I wanted to say there.
Well, thank you for saying that, and I think you're absolutely right. It's really incredible, and I don't think it's any fault of the average investor to get to retirement and then say, okay, here's what I got, make it work for me. And because there seems to be this narrative that if you put some money away in your 401k and you work for 25 years for the same company, that you should be all right. Well, we want to make sure, and to Jeannie's point, the sooner that you work with a financial advisor and the sooner that you build a roadmap, and the sooner you visualize where it is you want to go and what your retirement wants to look like.
Absolutely. Yeah, that's a financial plan. You've
That's
got to know where you are, where you're headed, and then where do you want to be.
And
we can help you get closer to it or maybe realize it.
And the sooner you do that, the greater the likelihood you get there. And we only touched on two of the current market metrics right now, one on the bearish, one on the bullish side. There are dozens more. We could literally have this conversation for hours, but unfortunately,
we bore our audience to
we might keep them more engaged. I don't know. I mean, I could geek out about this stuff for hours. I just love it.
Yeah.
But regardless, I think the point that you make is very sound, in that we want to make sure that you know that there are resources in town, and resources, quite frankly, no matter where you find yourself in the country, that understand these things for you, because so that you can go about your life and live comfortably and confidently, whether you're in the beginning, the middle, or towards the end of your career in retirement. If you aren't a financial advisor your entire life, you shouldn't have to be one in your retirement as well. And that's what we want to do for you. So I'm so blessed to be able to work with some of the smartest financial advisors here in Louisville, and we welcome the opportunity to serve you. So on behalf of myself and Jeannie, thank you.
Yes, thank you very much. It's been a pleasure.
Well, I'm glad we'll have you back for sure, and I look forward to it. And on behalf of everybody here at Kentucky Planning Partners, thank you for listening in. We are located at the heart of Louisville's east side on the corner of Shelbyville Road and Hurstbourne Lane in Louisville, Kentucky. Our phone number is 502-394-0400. Share this on Facebook. Like this page if continue to follow us, and check us out. Our website is www.kpp-lpl.com. We'll be posting these shows as podcasts in the relative near future. So we're looking forward to expanding the network that we have here, and we're so grateful to each and every one of you that tune in every week. So keep the feedback coming. Keep calling into the office or sending us emails. We love hearing from you. And with that said, thank you again. Hope you have a great week.